Opendoor closed out Friday's session deep in the red, down around 7%, finishing the day at $7.57 a share. That's a 57-cent decline in one session, and to anyone just glancing at the chart, it probably looks rough. But to understand what's really going on, we have to separate the noise from the narrative. Because while the market turned risk-off in a big way late in the session, what's happening inside Opendoor tells a very different story. One of operational tightening, smarter AI-driven cost control, and a company quietly building a foundation for its next phase of growth. The first thing to acknowledge is that this wasn't an Opendoor-specific sell-off. The entire US market fell sharply on Friday afternoon. Investors reacted to renewed geopolitical tension, especially the reports of potential new tariffs from Donald Trump targeting Chinese imports, particularly rare earth materials and tech components. That single headline rattled markets across sectors. Tech led the decline, with Nasdaq-linked names taking the brunt of it. High volatility growth stocks got hit hardest, and Opendoor, with its AI and tech branding, tends to move more aggressively in both directions when sentiment swings. So while the drop looked severe, it wasn't unique to Opendoor, it was part of a broader, index-wide wave of selling. Still, what makes Opendoor interesting is that on days like this, the company's internal story continues to evolve in a way that contrasts the fear on the screens. While most investors were staring at red tickers, Kaz Nejatian, Opendoor's CEO, was posting a fascinating series of messages on X, and they said a lot about where this company is headed. His posts weren't about share prices or quarterly targets. They were about culture, discipline, and the integration of AI deep within the company's operations. Kaz wrote that Opendoor's procurement team is now using AI tools to cancel wasteful SaaS contracts across the company. He said that in one division, they're going from 10 different software providers down to just one plus an internal AI tool, saving millions of dollars a year. He followed that up by saying this is happening across the board at Opendoor, because the proliferation of SaaS tools across companies has become a silent drain on resources. Then, in another post, he said, and this was both funny and telling, no, we don't need a SaaS tool just to create org charts. That tone, half practical and half tongue-in-cheek, captures something important, a company that's finally reining in its excesses. This is a signal that Opendoor is maturing. The free-spending tech era, where every problem was solved by buying yet another subscription or third-party tool, is over. Now it's about efficiency, integration, and control. And the fact that Opendoor is deploying AI internally to make those decisions, using AI to optimize its own structure, is a strong reflection of how seriously Kaz is taking the AI-first transformation he's promised. That message fits perfectly with the leadership updates Kaz shared earlier this week. The company added several key hires: John LeGrice from Shopify to lead operations, Morgan Brown from Dropbox to lead growth, and Brad Borney as Chief Business Officer to oversee sales and partnerships. Each of these names comes from a high-performance tech environment, the kind of place where data-driven decision-making and operational excellence aren't optional, they're expected. John LeGrice, for example, worked directly under Kaz at Shopify. She led operations, finance planning, and business analytics. Kaz said himself that there's no one he trusts more to help Opendoor find its next gear. That kind of endorsement matters. It means we're seeing a company not just trimming costs, but building out leadership capacity with the same intensity as a top-tier Silicon Valley firm. Morgan Brown, meanwhile, is well known in marketing circles. He's literally the guy who wrote one of the defining books on growth strategy and customer acquisition. His addition signals that Opendoor isn't just thinking about internal efficiency, it's positioning to scale its brand and its audience in a smarter, more data-driven way. When you bring in someone with that kind of growth marketing pedigree, it's because you expect to have something worth amplifying. And then there's Brad Borney, who's stepping in as Chief Business Officer. He's leading partnerships and sales and comes with deep familiarity with Opendoor's history and ecosystem. He'll be focused on expanding software access to partners and builders, and that could quietly unlock new revenue channels beyond the core buying and selling model. Together, these hires round out the leadership structure for what Kaz called an over-the-air upgrade to Opendoor's executive team. That phrasing is perfect. It captures the mentality that this is a living system, not a static company. Just as a Tesla improves with software updates, Opendoor is rewriting its own operating code. Now, combine that with Friday's cost-cutting posts and you start to see the pattern. The company is rebuilding itself from the inside out, becoming leaner, faster, and more integrated. And that's why days like this, even the big red ones, don't actually break the long-term story. They're just noise on the way to structure. Because at the end of the day, markets are reactive, but transformation takes time. A company can be executing perfectly behind the scenes while the stock still swings wildly from sentiment. We saw this exact dynamic play out with Carvana when it was trading sideways between $7 and $10. It spent months building its base, shaking out traders, and then launched into a sustained multi-month rally once the market realized it had survived. The same thing happened with Palantir. I remember buying Palantir when it was trading between $8 and $18 for months. People said it was going nowhere, that the story was over. Then AI hit the mainstream, Palantir proved it was a real player in that ecosystem, and the stock skyrocketed to over $150. Those examples matter because they remind us that price action doesn't always reflect progress. Consolidation and volatility are often preludes to growth, not the opposite. The same structural forces might be at play right now with Opendoor. We're seeing the final shakeouts of impatience. We're seeing the kind of red candles that historically have cleared the deck before stronger hands take control. If we zoom out, Opendoor has spent the past month trading in a fairly well-defined range, between $8 and $9. That's the same consolidation pattern we've been discussing in recent videos. This drop to the mid-sevens could be the range test we've been waiting for. It's the kind of move that looks dramatic intraday but actually serves a technical purpose. It clears weak hands and retests the conviction of those who remain. If the stock can hold this zone, even just stabilize above 7.5, it reinforces the idea that the base is still forming, just at a slightly lower altitude. Now, let's look at the timing. We're just a few weeks out from Opendoor's next earnings report, scheduled for November 6th. That's the next major catalyst on the horizon. If the company uses that moment to show tangible results from these internal shifts, things like expense reduction, improved gross margins, or even stronger transaction efficiency, the market will take notice. It won't take massive numbers, just credible evidence that the AI-first operational model is working. And that's where Friday's posts become even more important. Kaz isn't waiting for earnings to tell the story, he's building the story in public. He's showing investors that the company is already acting like a disciplined, AI-driven enterprise. That narrative, AI-enabled cost savings, is one of the strongest in the market right now. It's what institutional investors are looking for across the board, real AI integration, not just marketing. Remember, this isn't a company that's talking about AI for hype. It's using AI to optimize its own spending, streamline its workflows, and build its own tools. That's a crucial distinction. It's not using someone else's software, it's building its own. And that internal capability, if it keeps scaling, could become an entirely new revenue advantage down the road. Beyond that, there's also a macro angle. Mortgage rates are still high, but they've stopped climbing. We're seeing early signs that housing demand is stabilizing, and when it does, companies like Opendoor, which sit at the intersection of housing and technology, tend to benefit disproportionately on the rebound. In other words, they're the high beta plays for housing recovery. They move faster both down and up, and that's exactly what creates opportunity. When you combine improving market structure, AI-driven operational tightening, leadership upgrades, and upcoming catalysts, the long-term bullish thesis for Opendoor stays intact. The noise on the chart doesn't change that. Let's be real, red days hurt. But they also clarify things. They remind us of what we're actually betting on. We're not betting on the daily chart. We're betting on the architecture of a company that's evolving faster than most of its competitors. Kaz Nejatian's leadership continues to impress in that regard. He's blunt, transparent, and focused. His public posts don't sound like a PR team wrote them, they sound like a founder. They're direct, pragmatic, and infused with a builder's mentality. That's exactly the kind of leadership you want steering a turnaround. As we head into next week, the key is perspective. This 7% drop doesn't change the fundamentals, it just reminds us that conviction gets tested before it gets rewarded. The company is actively reducing costs, unifying its tool stack, expanding leadership talent, and doubling down on AI integration. Those are long-term structural improvements that the market will eventually have to price in. If the broader market stabilizes, Opendoor could quickly rebound back toward the $8 range, where it spent most of the past month consolidating. And if momentum resumes ahead of earnings, that could set the stage for another breakout attempt post-report. So even though it's been a rough end to the week, the long-term view hasn't changed. Opendoor is doing exactly what investors said it needed to do, cutting waste, hiring proven leaders, and using AI not as a gimmick but as a cost saver and performance enhancer. Every great growth story has these moments, the ones that test patience, shake confidence, and blur the line between conviction and doubt. But that's often when transformation is happening the fastest. So don't mistake today's red candles for failure. They're just the surface reflection of a market reacting to macro noise, not the inner workings of a company evolving in real time. Beneath that surface, the engine is being rebuilt, stronger, leaner, and smarter. In the months ahead, we'll see if the market catches up to that story. But one thing's for sure, Opendoor isn't standing still. It's rewriting its own operating system, and when that new system takes full effect, the results could surprise a lot of people who gave up too early. That's why I'm staying focused, not fearful. Because what we're seeing right now is what strength looks like before it's recognized. And as long as the company keeps aligning execution with vision, I believe Opendoor's next gear is still ahead, not behind.